how China is replacing dollars to gold through BRICS. We're going to look at something that's reshaping the global economy in quite dramatic fashion. The recent spike in trade tensions, the sharp moves in assets like gold and crypto, and the decisions companies and investors are making in response. But beyond that, we're going to talk about what might come next, because up next doesn't just mean tomorrow. It means the months ahead, the possible scenarios, and how you might think about them. Earlier this year, and especially in recent weeks, the United States announced a major escalation in tariffs, particularly aimed at goods imported from China. Some of the possible tariffs being discussed were as high as 100%. That kind of jump isn't incremental. It's a dramatic shift. The markets reacted very fast. For instance, gold prices surged through the $4,000 per ounce mark and climbed above about $4,300 in mid-October. Crypto markets, which are extremely sensitive to leverage and policy shifts, were hit hard. In a matter of hours, around $19 billion of leveraged crypto positions were liquidated. Stocks also suffered. On the first trading day after the tariff announcement, U.S. major indexes posted significant drops, especially companies with strong China exposure. Oil prices fell too. Traders began to assume that if trade slows, manufacturing slows, shipping slows, and that means less fuel demand. So, crude oil slipped by more than $2 per barrel in some sessions. In short, one policy move opened a chain reaction across multiple asset classes and industries. Why it matters? First, tariffs is equals to extra cost. When a company imports goods components, finished goods, whatever, and suddenly it faces a 100% duty, either it absorbs the cost, which squeezes profit, or it passes the cost to consumers, which raises price. Either way, costs go up, choices tighten. Second, demand may weaken. If businesses anticipate higher costs or slower global trade, they may delay investment, hiring, and output. Consumers seeing higher prices may cut back. That means global growth takes a hit. Third, investor behavior changes. Uncertainty goes up. Trade policy is no longer background noise. It's front and center. When uncertainty ticks up, investors look for safer places. That helps explain the jump in gold. On the flip side, assets exposed to trade risk like global supply chains, heavy China linkages, get hit. Fourth, interlinkages matter. When trade slows, shipping drops, factories idle, fuel use declines. That touches oil and commodity markets too. So, you have a set of ripple effects. Policy affect business cost and demand, and business cost and demand impact investor flows, and investor flows affect asset prices. So yes, this matters, not just globally, but every time you buy something made abroad, or a company you own sells abroad, or you invest in global stocks or commodities. We're not just seeing headline risk. The major institutions are flagging real concerns. The International Monetary Fund, IMF, recently updated its global growth outlook. For 2025, it now sees around 3.2% growth, and for 2026, about 3.1%. If growth stays modest or weakens further, assets that rely on growth like stocks, commodities, face headwinds. Safe havens get more attractive. The IMF also emphasized that renewed U.S.-China trade friction remains a significant downside risk. That means the scenario we're in isn't normal, but one where things could shift quickly. In Asia, growth is holding up better than some expected. For instance, India is projected to grow around 6.6% this year and 6.2% next year. But even here, slowdowns in demand from external economies are a concern. Will gold rise or fall? Gold surged past $4,000 per ounce in early October 2025 and hit levels above $4,300. Why it moved? Gold is a traditional safe haven asset. When investors sense instability, whether from trade policy, rate decisions, or geopolitical risk, they buy gold. If the dollar weakens, or if U.S. real interest rates drop, gold becomes relatively more attractive. Central banks have been buying gold at a faster rate, absorbing supply and adding to upward pressure. Major financial institutions are forecasting continued upside. For example, HSBC expects gold, could hit $5,000 per ounce in the first half of 2026. Bank of America has a more bullish scenario. It forecasts gold could hit $5,000 per ounce in 2026 if investment demand increases further. If the U.S. Federal Reserve cuts interest rates or keeps them lower for longer, real yields would drop, making gold more attractive, since gold doesn't pay interest. If the U.S. dollar weakens, the price of gold, which is dollar-denominated, becomes cheaper for foreign buyers. It will be boosting demand. If geopolitical or trade tensions persist or worsen, which raises safe haven demand. If inflation falls faster than expected, or if the Fed raises rates because of inflation or other shocks, real yields could rise, reducing gold's relative appeal. If a strong economic rebound occurs and risk appetite returns, investors may shift from safe havens back to risk assets. Imagine you're an investor deciding now whether to allocate more to gold. If you believe trade friction will stick around, central banks will keep buying, and yields will drop, you might lean heavier into gold. If instead you think trade deals will succeed, growth picks up, and rates rise, you may hold, but not chase. The future of crypto. On October 10th to 11th, 2025, the crypto sector experienced one of the largest liquidation events in its history. Over $19 billion in leveraged positions were closed in a short span of time. For example, Bitcoin dropped from above $120,000 to around $106,000 in rapid order as the shock hit. Crypto markets are heavily leveraged. When a big shock hits, forced liquidations cascade and amplify the move. Because the markets are thinner and less regulated than major equities, volatility is higher and surprises can hit harder. On the upside, if institutional adoption continues, custody advances, regulation improves, and stablecoin systems mature, crypto could build more resilience. On the downside, another macro shock like trade escalation, regulatory crackdown, major stablecoin stress could trigger another massive drop. If you hold crypto or trade derivatives, you might monitor funding rates, open interest on exchanges, stablecoin peg stress, and macro headlines. One strong warning sign: when open interest spikes and funding rates go extreme, it often precedes a blow-off. The future of stocks and companies. Equities and companies are where theory meets reality. The functioning of companies, supply chains, and trade links is being reshaped. Companies that rely on China, whether manufacturing there or selling there, are now more exposed than ever. Trade policy changes raise costs and may dampen demand. For example, large tech and consumer firms with complex supply chains are vulnerable to margin pressure. Firms primarily serve domestic markets, which is less exposed to global trade. Companies shifting supply chains to lower-risk geographies or reshoring production. What to monitor? Announcements of tariff implementation, on which goods, and when these often cause cost shocks. Supply chain relocation, moves by companies. If a major company says, "We're moving out of China," or increasing domestic production, that signals cost pressure. Earnings warnings from companies citing tariff or cost exposure. For example, if you own a company that assembles key products in China or sources major components there, a steep tariff could raise its input cost by, say, 10 to 15% overnight. That eats into profit margin. If the same company has heavy sales into China and Chinese demand weakens, that's a second hit. On the other hand, a company that sells domestically in the U.S. and sources locally may avoid much of that pressure. The future of oil. Oil may not always headline the trade story, but it often reflects the underlying reality of manufacturing, shipping, and trade. After the tariff announcement, shipping and manufacturing expectations fell. Oil prices dropped by more than $2 per barrel at one point. Agencies like the International Energy Agency, IEA, are forecasting weaker demand growth for 2026, possibly even supply outpacing demand by 3 to 4 million barrels per day. Unless there's a major supply disruption, oil may drift sideways or downwards rather than sharply up. If 1 week U.S. inventories build significantly and shipping data shows trade volumes falling, that may be a signal that oil demand is weakening and prices may move lower. Let's summarize what you should walk away with from this. First, policy matters. Tariffs or trade policy shifts are not just political theater. They impact costs, demand, investment decisions, and global flows. Second, across assets, different rules apply. Gold is behaving like a safe haven hedge. Crypto is highly leveraged and volatile. Stocks are differentiated by trade exposure. Oil is signaling demand. Third, the future is not predetermined. We have scenarios, not certainties. What you believe about policy, growth, rates, and global trade will inform what you do. Fourth, for you, whether you're investing, managing risk, saving, or just paying attention, think in scenarios. Ask yourself, what if tariffs expand? What if they ease? What if central banks cut rates? What if growth picks up? What if it doesn't? Being prepared for what could happen can matter more than trying to guess exactly what will happen. Thanks for watching. I'd love to hear what you think. Which scenario seems most likely to you over the next 12 to 18 months? Leave a comment below and let's discuss.